Hello, everyone, and welcome to today's webinar, Optimizing Fixed Income Portfolios Using Sector ETFs. Before we get started, I would like to go over a few items so you know how to participate in today's event. You will have the opportunity to submit questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time, and we will collect these and address them during the Q&A after the presentation. All participants are eligible to receive one CFP Board CE credit for attending this webinar. If you are a CFP Board member and would like to obtain the credit, please email your CFP Board ID number to sgreco@snetworkinc.com. I would now like to introduce Young Lim, CEO at Folio Beyond, and Jamie Visconti, Chief Marketing Officer at Folio Beyond.
Thanks, Sarah, and thanks everybody for calling in today. We're going to just give you a quick agenda here to give you an idea of what we're going to cover. Young and I will be going through the whole presentation, taking turns here on different sections. I'm going to start with an overview of the fixed income markets, discussing efficiency, participants, and different investment styles that managers take to that market. Young is going to discuss a process for optimizing portfolio construction using ETFs across the fixed income universe. Then I'll discuss the benefits of this approach and a practical execution channel for investors to utilize, and some broad historical performance metrics. Young is going to follow up with some more detail in terms of recent portfolio performance and return attribution, and then we'll have some time for a few questions at the end. So, moving into our first slide, are the fixed income markets efficient? I mean, they clearly aren't, and there's a lot of reasons that they aren't efficient, and a lot of it goes back to who the different participants are and the constraints and goals that they operate under. And we just have a few examples up here of some different investor groups that have different objectives and different constraints. Broadly, insurance companies, their portfolio construction is driven by their policy duration. They have different regulatory environments at both the state level and the state regulatory capital requirements and tax environments. And they also have to meet the required protocols of the NAIC ratings universe. Pension funds, on the other hand, tend to have much longer term liabilities based on the distribution requirements that they're subject to, many of which were set in higher rate environments. So they're really, you can see that in today's markets where they're really driving longer rates down as they try to meet these liability obligations for their beneficiaries. Banks and depository institutions, they operate under a different regulatory capital requirement, typically more credit driven, and their asset liability mix is driven by funding and loan duration matching, depending on their loan book. And, last but not least, retail or high net worth investors, I mean, they have long-term investment needs. They're trying to maximize returns over longer horizons for retirement and future, wealth management and wealth building strategies, but they also have liquidity needs. So while they may have demand for higher yielding, more credit sensitive products, they also have a demand for shorter duration, high grade products that provide them with liquidity when necessary. So there are many different drivers, obviously, and what that really does is make for a market that is not always that efficient. I mean, the equity markets are very different in terms of how they operate versus the fixed income markets. The fixed income markets have a relative value methodology or framework, I should say, in the sense that certain assets are cheap relative to other assets, and you want to basically try to get exposure to the assets that are cheaper. And all of these different constituencies, or the advisors who represent these constituencies, are trying to do that in different ways. So moving on to the next slide. So, again, how can an investor take advantage of these inefficiencies in the markets? And I mean, there's some critical things that investors really across the spectrum have to acknowledge in terms of how they address portfolio management and construction. And we just highlight a couple of things here. I mean, traditional bond trading and fixed income markets suffer from a significant lack of transparency in the cash markets. And by that we mean, in many cases, only the dealer community sees bid-offer spreads in transactions with any regularity, and those specifics are not seen by really any non-professional investors, making it somewhat opaque in terms of execution. And a lot of fixed income pricing inefficiencies are difficult to quantify, certainly to the layman in the market. I mean, there are many characteristics that drive those inefficiencies. We alluded to some of them on the last slide. There's credit, credit risk, and the cost of that credit risk, or the pricing of that credit risk in specific instruments. There's prepayment optionality. There's call provisions as well in many bonds. Bonds have different durations, different maturities, so their interest rate sensitivity is different. And in this environment of low rates, duration has become a more heightened risk for longer duration assets, or the risk associated with them in this low rate environment. And then the convexity risk, people think of that typically in terms of the mortgage-backed world, where you have the ability to see your bond's duration extend significantly if rates are to rise. So, these can be difficult to monitor on a real-time basis, and what it really requires is, a methodology to calibrate these risks and be able to look at the sensitivities around changes in those measures over different perspective horizons, and actually looking back over different historical periods to understand how to manage those risks. So any of these inefficiencies need a consistent, rules-based, algorithmic approach to extract value out of working with them or working around them. So, what strategies can be used to address these inefficiencies and risks and ultimately opportunities in the markets? I mean, we all know that there's the big debate in all markets today versus passive and active management. In terms of fixed income, passive management can be viewed broadly as just an index approach. I mean, the biggest index that most investors think about in terms of the fixed income markets is the Bloomberg Barclays Aggregate Index, or AGG, just a very broad market, high-grade index. And most active managers, or most active measures in the market, and the portfolios that are managed actively in the market, are strategies that are trying to beat that index. And they're beating that index by taking risk that's typically outside of the index construction. And what we mean by that is they're taking credit risk that doesn't exist in the index, and they're also taking duration risk that doesn't necessarily exist in the index. So they're taking, going further out on the yield curve, and they're taking lower grade credit exposure in their portfolios. And you can see that in the what we'd say some of the more or the most popular total return strategies, and by that we mean strategies that are trying to maximize return across the universe of fixed income investments. There's the core and core plus active space that basically is the Barclays Agg plus credit risk. The unconstrained, or what is, I guess, Morningstar terms the non-traditional active space, which is really kind of a go anywhere approach, again, across all sectors in the fixed income universe. And then the multi-sector active approach, obviously, and the name says that as well, being able to look across different sectors. And all of those are attempting to beat the benchmark index by taking those risks of credit and duration and other prepayment risk, call risk, liquidity risk in some cases. So the question is, what process do these different strategies use to achieve that, that effort to outperform the benchmark index? And it's really, in this case, it's a measure of the risk that they're willing to take versus the high return target that they're trying to achieve versus the risk that they're willing to take. And that means that they, active managers and to a certain extent passive indices, are targeting a risk level, a risk tolerance that they find acceptable, and then attempting to maximize returns while maintaining that risk tolerance or target. And traditional active managers use quantitative tools to do that, to measure the risk across their portfolio. While they may be, more active on the human level in terms of selecting bonds and biasing exposure towards sectors, they're still using, broad, accepted market metrics and measures to calibrate and manage to the expected risk on their portfolios. But now there's another way we can go about this, which is a more model or rules-based approach using algorithms. and that requires setting a risk tolerance or target as well, but that's just one of the rules in the process. Attempting to optimize for returns versus a constraint on risk is how a rules-based approach would be broadly constructed. So now I'm going to hand this over to Young for our next slide.
Thanks, Jamie. We can start by looking at the fixed income world and dividing up the fixed income space into various subsectors. A lot of investors and participants typically think about 5 or so buckets in the fixed income markets, and in many cases they use broad-based strategies. The approach here looks at the various discrete subsectors of the market, and if you sort of divide up the world based on credit, product type, and duration, we do come up with 23 subsectors in the fixed income space. So across the top is the different credit levels, and then below that is different product types within the various credit spectrums. And then further below are the different duration buckets. So as an example, for U.S. governments, you have the various duration buckets. You have less duration buckets for TIPS, but that's a separate, somewhat less correlated sector of the government market. And then you have agencies and non-U.S. sovereign, as well as investment grade and high yield products. And as you can see, even in the investment grade space, you have structured credit, corporate bonds, municipals, and different subsectors in the high yield market as well. So if we start with that universe of 23 or so discrete subsectors of the market, one approach to modeling asset allocation would be to optimize portfolio allocation across the subsectors. And the optimization approach we're going to be talking about relies on optimizing sector allocation and sector rotation based on a framework that looks at forward-looking values. Forward-looking valuations are measures that experienced portfolio managers in the fixed income markets like to look at. And typically, they would look at forward-looking values adjusted for different embedded costs. Some of these embedded costs include option costs, default costs, and other embedded risks. In addition to the value measures that really play into relative value analysis, any kind of approach should incorporate the risk factors, obviously, which includes historical volatilities adjusted for implied vols and momentum effects. When all of these parameters are incorporated into an optimization framework, the results are compelling in the sense that it's providing an objective and optimized portfolio allocation that takes into account the current market levels and various underlying measures. So to summarize the high-level approach, based on the universe of the 23 subsectors we talked about, we would want to select best-of-breed ETFs that represent passive exposure to each of those subsectors. So a best-of-breed approach would be agnostic to fund families, and it would evaluate the consistency of sector exposures, the size of the ETF, any liquidity issues, index tracking, and manager quality. Using the selection of best-of-breed ETFs, the systematic model would be optimizing the allocations based on some of the variables we talked about, looking at both primary and secondary factors. And it is a systematic asset allocation process that does not incur any of the biases that might be present with a qualitative process. And we want to reemphasize that it's important to look at forward-looking valuations as opposed to backward-looking returns. Some models focus on historical returns. And while historical returns are important in assessing volatility and correlation effects, a true value measure should be based on forward-looking yields and returns that price out, as we discussed a minute ago, options, credit risk, tax effects, and other inflation forecasts for certain types of bonds. Now, let's delve into the model in more detail, starting with the valuation aspect of the model. So this slide outlines the major components of valuation that are important in understanding fixed income valuations. The first is duration, which reflects the yield or compensation that investors get for taking interest rate risk. Prepayment risk is present in only certain types of bonds, mortgage bonds in particular, as well as some corporate bonds where the possibility of paying off the bond creates optionality and it causes negative convexity, which means duration would shorten in a rally and extend in a sell-off. So call risk we just talked about for corporate bonds. Default risk is present for all types of non-agency bonds. In the investment grade sector, default risk is less significant, but as you go down in credit to high yield and sub-investment grade, the default risk obviously becomes more meaningful, and it's important to understand and quantify default risk based on the exposures you're getting in the bond market. The tax rate and inflation aspects are tied to muni bonds on the tax rate and TIPS on the inflation factor, and this is where we want to bring valuations to an apples-to-apples comparison. So if you're a tax-advantaged investor, investing in a muni bond has tax advantages, so that has to be factored in before making the valuation comparison. And in terms of inflation forecasting, TIPS rely on what the inflation numbers are going to be in the future as the coupons adjust to inflation numbers, so that has to be factored in valuing TIPS. Now moving on to the risk side of the equation, as we look at the relative values, all of that has to be reviewed in relation to the underlying risks and other aspects of risks that affect performance. So historical volatility is a good gauge for understanding the volatility of each subsector, but as we've experienced on an ongoing basis, historical volatility can certainly be different from current implied vol levels. Implied volatility levels, whether it's taken from the swap option market or other option markets, reflect what investors see as the current and forward-looking volatility levels. So it's important in this kind of modeling exercise to not only account for historical volatilities, but also make the proper adjustments to reflect current implied volatility levels. Another factor that is significant in the fixed income markets is price momentum. For various reasons, momentum effects exist, and you want to factor that in, whether it's positive or negative price momentum. In our modeling approach, the momentum effect affects the risk of the instrument positively if it's a positive momentum, and negatively, meaning the risk numbers are increased if the price momentum is downward. Other aspects of the of bond risk, as well as overall investment risk that's important, is correlation risk. To the extent that you have negatively correlated assets, you get the positive portfolio benefits. So in a portfolio of multiple bond sectors, you need to factor in correlations properly, and other aspects of the analysis or optimization that can be included include some of the other parameters such as bond level metrics. For example, duration can be included as a constraint, or any other client-specific constraints can be included in any kind of optimization analysis. So when you put that whole process together, it is a comprehensive approach that looks at value and risk. And underlying this whole process is proper risk management. So given this type of framework, an optimization analysis will involve generating the results on a daily basis. You certainly don't want to generate trades that occur on a daily basis and incur transactions costs. So you want to rebalance the portfolio and the model only as needed. And one approach to doing that is to set thresholds for rebalancing. In other words, if the risk targets deviate from what's in your current portfolio by a certain threshold, that might act as a trigger to rebalance the portfolio. As we discussed earlier, volatility should be based on both a combination of historical and forward-looking volatility levels. Correlations are important, and another component that comes into play, especially in stress environments, is understanding stress risk. What's the downside in an '08 type of environment? So one approach to incorporating that effect is to add as a constraint in the model what kind of downside you're willing to entertain or take on in a very stressed environment like '08. So that could be part of the optimization framework. And lastly, but not the least, is the momentum effects that tend to skew the results and the risk numbers, and that has to be factored in a proper optimization framework. One other thing we'd like to touch on is talk a little bit more about customization. The model of this sort can be constructed in a very customizable manner. Some of the concepts and optimization techniques that we talked about rely on understanding value and risk, but what you want to enable the model to do is be able to customize the usage based on client-specific requirements. So we talked about limiting duration risk. So if you're a longer-term investor, let's say it's a 10-year kind of horizon, you can set the duration to be 10 years plus or minus some kind of deviation. And as you get to that terminal date, you'd want to lower the duration target accordingly. So a model should have that kind of flexibility. In terms of sector exposures, we talked about the 23 sectors here, but you can certainly exclude certain subsectors if that's your goal. If you want to exclude emerging markets, that should be an easy customization. You also want to be able to dial up or dial down the various risk dials. So a highly liquid strategy with lower risk numbers should produce lower returns, but that kind of risk dial can be easily implemented. And while we talked about using best of breed products, another application would include a hybrid approach where these best of breed products can be combined with client-specific products, or it could all be 100% based on a fund platform's products. So the approach should be set up to be flexible and customizable depending on the client needs. So I'm going to turn it back to Jamie here to continue the discussion.
Thanks, Young. So when we look at this approach, the broad approach across 23 ETFs, how does this fit into a overall portfolio or portfolio construction for an investor? And again, we have different investor constituencies, but what we really think of this strategy as is a total return approach to fixed income investing. And what it allows for on a simplified basis for the advisors and investors who use it is a single strategy that looks across virtually all sectors of the fixed income markets. And what it attempts to do is deliver alpha versus the benchmark, the Barclays Aggregate Index, and also versus other peer strategies or categories with similar levels of risk. So again, Young talked about risk thresholds a few minutes ago. We're setting risk targets in a portfolio that's constructed like this that are really broadly equal to the benchmark, in this case, the Barclays Agg. And by targeting that benchmark, but using the optimization methodologies that Young described, we are attempting to optimize for returns, but still maintaining that same target level of risk. So what does that ultimately do? Well, it means we're providing, in this approach, an institutional quality asset management strategy that is utilizing a very practical methodology, a forward-looking expected return methodology, which is consistent with traditional total return fixed income management, but it's using technology that really, in most cases, and data delivery systems that in most cases were not available 5 and certainly 10 years ago. In terms of the development of the ETF markets and the liquidity that they've provided, the ability to actively trade in those markets, it provides a whole new level of liquidity in the fixed income sectors that has really been absent or declining when you think of the cash fixed income markets. So how does an investor execute this? Well, currently we have a partnership with S Network, which is a $7+ billion index provider, where we have an optimized fixed income index that is produced daily. We have the index is available on Morningstar with 10 years of historical data, and we're delivering that through the TAMP universe, the Turnkey Asset Management world. And we started that with the SmartX Advisory Solutions platform. They're really the only platform that offers traditional, alternative, and passive direct index strategies on one platform. And when we look at how this delivery has been set up, it's really seamless and very easy to execute. As Young indicated earlier, we're basically running these portfolio constraints and models daily, producing an index construction on a daily basis, and to the extent that changes, it gets delivered through the index provider, S Network, through to the SmartX platform, and then ultimately to the end investor users to execute. Just to give you guys some perspective on historical returns and performance, the underlying indices that we use that support the ETFs that comprise these 23 broad sectors and subsectors go back roughly 15 years. So we can look back to 2005 to get a measure of relative performance. And against the Barclays Aggregate Index, you can see that we've outperformed with this approach by in excess of 200 basis points per annum. Now, that is obviously taking more credit risk primarily, probably pretty similar duration if you look back at the data relative to the Ag, but we are doing it while maintaining the same historical volatility levels of the Barclays Aggregate Index. So again, optimizing for return, but controlling for risk. And we're going to highlight, and you can basically download later the 2-page handout that's part of the webinar here that shows performance relative to those composites we discussed earlier, Core Plus, unconstrained or non-traditional, and multi-sector. And what you'll see there is that this rules-based approach also comfortably outperforms the vast majority of those actively managed strategies. So Young is going to give us a little more color on more recent performance here.
So looking back to 2019, this chart here shows return attribution, well, more along the lines of what kind of exposures the portfolio optimization generated and some of the underlying commentary behind that. So if you remember Q4 and particularly November, December of 2018, we had the mini credit crisis where spread products widened, and as the downward momentum effects were somewhat significant, our portfolio towards the end of 2018 were less exposed to credit. So this picture here shows you what happened over the course of 2019. So as the year started, the markets stabilized a little bit. Valuations were more attractive, and some of the negative momentum effects that I alluded to sort of dissipated. So the model allocated to credit portfolio comprised mainly of short-dated high-yield corporates, high-yield munis, and bank loans with some long-duration treasury exposure. So the relative value component became a more dominant factor as risk levels subsided. Now, fast forward a few months or towards the middle of the year, as the bank loan market rebounded, as well as other credit products, the bank loan sector in particular became more pricey relative to other comparable sectors, or other sectors, I should say, and that exposure, middle of the year, was replaced with a mortgage REIT exposure, which sort of lasted most of the second half of the year. And in the middle part of the year, there was a little bit of a minor rebalancing when long-duration high-yield corporate exposure was allocated to opportunistically on a small scale, and as well as a little bit into government agencies. And then, as I said, towards the latter half of the year, it was a combination of mortgage REIT, short-dated high-yield corporates, and high-yield munis, offset by some long-duration treasuries. So it's interesting how the model also kept a long-duration treasury exposure in the portfolio, albeit at varying allocations. And I think that was based on risk diversification. It sort of met the guidelines of the risk targets and return volatility targets, since treasuries are less volatile than some of the credit products. And at the same time, the model looks at correlation effects, and treasuries probably provided a good offset, or essentially acted as a little bit of a shock absorber, especially in flight to quality bond market rallies. And we saw that multiple times over the course of the year when you had a flight to quality rally accompanied by spread widening. So if you only had a credit exposure on your books, you would have underperformed the overall bond market. But the long treasury exposure served as a good diversification to the overall portfolio. But that all sort of comes out of the construct of the model and how the optimization looks at forward-looking return projections relative to various risk levels and how the correlation effects come into play. With that, I'd like to turn it back over to Sarah.
Okay, thank you, Young and Jamie. We're now going to begin answering the questions submitted during today's presentation. As a reminder, you can still submit questions through the questions pane in your attendee control panel. Young, our first question is, how is your approach to fixed income portfolio construction using sector ETFs different than other offerings in the index space?
There are a few differences, and they are major differences. First of all, a lot of the offerings in the marketplace, if it's an ETF solution, tend to be focused on some of the broad sectors, and there tends to be overlap. If you combine a few different ETFs that are exposed to the broad sector, and related to that is the fact that not all the subsectors are covered in any kind of strategy. So versus an all ETF solution, we are much more expansive and all-inclusive and really focused on discrete subsector exposures. In comparison to mutual fund or other ETF strategies where you're looking at an unconstrained bond strategy or a core plus strategy or a multi-sector bond strategy, I think there are a number of advantages versus each of those. Versus an unconstrained strategy, the concept is similar in the sense that you're sort of reallocating and doing the sector allocation as needed. The big difference is that we're doing it in a quantitative, systematic way where you're not leaving any stones unturned, in the sense that you're capturing all the changes in valuations, you're capturing all the changes in risk levels, you're staying on top of day-to-day changes in the marketplace. Whereas a traditional unconstrained approach, while it might have the benefit of some of the macro views of an experienced PM, may not necessarily capture all the effects and factors that we talked about. Versus a core plus approach, we have some similarities in the sense that we're trying to outperform relative to the Barclays index. The main difference is that we're looking in all the different places in the liquid fixed income markets. A lot of core plus approaches may not look at maybe 30, 40% of the subsectors that we've covered. Now, the important part of running the model the way we're running it is to make sure that your return vol targets are in line with the index. So if you just run this strategy without any limitations on return vol targets, you're naturally going to get higher return volatility given the credit exposures. But because we're limiting return volatility to be consistent with the index, it does the dynamic rebalancing as needed to keep vol levels in line with the benchmark. So to summarize, it's an advanced algorithmic approach that captures all the primary and secondary factors that most PMs ideally would like to look at in doing their portfolio management work, but it's done systematically using the latest analytical tools and utilizing liquid subsector ETFs.
Okay, great. The next question is for either Young or Jamie. What is the advantage of executing this in a TAMP format?
Well, it's Jamie speaking. I'll take that. Obviously, the ease of execution in the TAMP environment is very attractive. I mean, this is not a strategy that's meant to be actively rebalanced, as Young has indicated in his description and then just comments just on this last question. Clearly, there are times where the portfolio has to be rebalanced based on these volatility triggers or these volatility constraints, but that's not something that someone would want to have to do on their own if they were just receiving the index and executing it themselves. So through the TAMP format, obviously the investor gets a seamless exposure to this structure, similar to buying a total return fund in a cash mutual fund type structure. And then also from a cost perspective, in terms of what it costs to execute through the TAMP, you're talking about roughly 40 basis points. The underlying ETF fees are going to be another 20 to 30 basis points. So that's still at the low end of the range of an actively managed mutual fund. So you're getting similar exposure with arguably better expected returns over time at a lower cost using this in a TAMP format.
Okay, this is our last question, and either one of you can answer this. Going back to the beginning of your presentation, this is addressing the starting universe. How do you decide which ETF to incorporate?
Okay, good question. So, first of all, this approach requires, rebalancing of sector exposures. So we want the underlying ingredients to be a set of passive exposures. So we start with a suite of passive ETFs. So one constraint based on this approach would be to look at the passive ETFs that represent each subsector of the market. And just as a side note, in the future, we would be able to incorporate active ETFs as well, but we would need to model the alpha component of active ETFs the right way. So going back to ETF selection, we look at various attributes given the list of passive ETFs that represent each subsector of the market, and I'll list some of the main criteria. Its size, liquidity, tracking versus the index, quality of manager, and a few other qualitative constraints. But we want to, pick best 1, 2, or 3 ETFs in each subsector of the market. And fortunately, given the growth in the ETF space, this certainly wasn't the case 15 years ago. But there are liquid ETFs representing each of the 23 subsectors we discussed with good enough size. And as most participants might be aware of, there's an efficient secondary market creation and redemption mechanism that allows for the execution of large trades. So we have that due diligence process that selects best of breed ETFs, and it's reviewed on a regular basis. And as new subsectors get defined in an ETF format, such as, for example, an ABS ETF could be an interesting one to allocate to, as well as a CLO ETF. There might be other subsectors of the international markets that get carved up, but we're constantly monitoring any new exposures that might be represented in ETF format, and we also want to make sure that there isn't too much overlap in terms of products and risk and return profile across these ETFs, because the optimization framework works best if you're sort of working with discrete components in optimizing the portfolio. Sarah, back to you.
Okay, well, thank you, Young and Jamie, and thank you for everyone for attending today's webinar, Optimizing Fixed Income Portfolios Using Sector ETFs. You can access the fact sheet that was referenced throughout the presentation under the Handouts section to see the performance of the index as of Q4 2019. You will all receive a follow-up email within 24 to 48 hours with a link to view a recording of today's webinar. On behalf of the teams of Folio Beyond and NS Network Global Indexes, thank you for joining us and have a great rest of your day.